The LIBOR is a very important factor in the financial system. $370 trillion worth of financial transactions use the LIBOR today, but this is changing. New competition has formed, and some people believe that this could be very disruptive to the current financial landscape. Only time will tell. You came here for the truth, so let me unveil that for you. Today we're going to look at the LIBOR. I'm going to show you the competition. I'm going to look into the companies that have been using this new competition already, and so much more. Let's begin by taking a look at the LIBOR itself. Now, for those who don't know, the LIBOR is a benchmark rate that some of the world's leading banks charge each other for short-term loans. There's more details on it. It talks about the currencies it uses, but that's the basic definition, okay? So that's LIBOR. $370 trillion worth of transactions are moving through this thing. It's huge. It's a behemoth. Now, there is competition that is formed out of the Fed Secured Overnight Financing Rate, SOFR, is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. Again, this goes into more of the details if you're interested, but that's the basic fact. Now, as I said, you have one monstrosity on one side, and then you have this new one, the SOFR. It just started. It's not going to take over, in such a short period of time, but we're going to see where this competition really goes, and maybe other ones will form. Who knows? There's a lot of history behind the LIBOR. I'm going to touch on it a little bit today, and I have in previous videos. I wanted to show you this chart, the 3-month USD LIBOR. This is the most important of all the LIBOR rates that you can look at. 3-month is the one that you need to be paying attention to. And I want to point out one very, very obvious fact. You can see where we're at today, and you can see where we were at during the financial crisis. We are at the same levels that we experienced 10 years ago. Big problems here. For the longest period of time, we had very, very subdued rates. And now, today, this has changed. And I think part of this issue could be the fact that it is going to become, they know, it's going to become too expensive in order to do transactions using the LIBOR. And maybe they want an alternative. And there's another issue here as well I'll get into in a moment. But this is just what I'm thinking. Competition is good. I'm not denying that. I like that. However, I'm wondering why those at the biggest of the big banks care about the competition. I care about competition. But the big banks, the central banks, suddenly I start to scratch my head and think, what could they be up to? I wanted to point out this here. Collateralized debt obligations, just one example. We're talking about derivatives and how they use the LIBOR. See, you can see this. I just wanted to point out the fact to give you an idea of how this all works. Everything is using this LIBOR rate. It's so important. And they're using that. And of course, if it's going higher and higher, that's going to push up the prices. That's going to reduce the sales. Potentially profits will be reduced and so on. Okay, so just think about that. This week, Fannie Mae issued the market's first ever secured overnight financing rate securities. The 3-tranche SOFR debt transactions were $6 billion, and it's the first step to finding the alternative to the US dollar denominated LIBOR. That is the benchmark rates they use to determine the interest for short-term loans to one another. And it goes on to talk about the deal and so on, okay? This is important to understand where we are heading because it's going to take a year. It's going to take years. There's no doubt. And when we look at this, things just don't happen overnight. But the fact that there is something on a large scale being set up as an alternative makes us start to wonder what they're planning behind the scenes. It's not going to be good. It's not going to be beneficial, that's for sure. Nothing ever is in the financial realm. But I'm just interested to see how this all works. Barclays is the first bank to sell commercial paper linked to the LIBOR alternative. So here's another one. 1 month after the Fannie Mae became the first issuer to sell debt linked to the LIBOR alternative, Barclays became the first commercial bank to issue commercial paper tied to the benchmark, which regulators hope will replace the scandal-plagued LIBOR the so-called Secured Overnight Financing Rate, or SOFR. So keep your eyes on this. You're going to hear about it in the news, I'm sure, over the next few months, perhaps the next few years. Now, we're talking about the scandals, all right? So this scandal was 2012. This is when the information came out. Of course, it goes back as far as 2003, and I'm going to suggest to everybody it's a lot further than that. But we basically have all the big banks here: Deutsche Bank, Barclays, UBS, Rabobank, and Royal Bank of Scotland. RBS is one of those I just talked about in a recent video, getting into trouble there, and now they're in trouble again. So this is always going to continue to happen. You can see it going back as far as the banks exist. That's why they are these major corporations. They can do whatever they want. Okay, they pay a little fine, they get slap on the wrist. I'm sure they can write that off against their profits, and then they won't have to pay taxes that year. So ultimately, it's not really a loss for them. Okay, you have to understand that. Now, looking at this, they had basically been they've been manipulating the rate. And this here shows us that we can't trust these banks. We cannot trust these institutions to be able to do anything for us. They're not on our side. Okay, they've been rigging it. They got caught. They got a slap on the wrist, and they just continue to do it. That's all. No problem. Okay, so it gets more into the details. You've probably heard about it many times before, so I won't continue to cover it. But I wanted to show you this here. It's just one example. Student loans. We're talking about securitized. And looking at the student loans is just one example. We got the credit card debt. We've got mortgages. We've got personal loans, everything. All of this is increasing. All of it is taken, packaged up, and then sold on these markets. And maybe not, has to deal with the LIBOR, maybe some other interest rates. But what I want to point out is the fact that as interest rates rise, this becomes more difficult to do these financial transactions. So the velocity of money is going to be slowing down. That is so integral to what's really been going on over the past few years, because we've had super low interest rates for a long period of time. Now we're starting to see that going up. It is a big concern to anybody, number one, in the financial industry, but then the ripple effect and how that really affects everybody else down the line. So keep your eyes on some of these statistics. I think it's really important. Now that's it for this part of the video. My friends in India, I hear about requests all the time. Please do some videos on India. Well, just this little piece here I found, and it's loosely connected in with that. 99.3% of demonetized money returns to the RBI. You remember what happened? They basically brought those currency in one day. They basically said, we're going to end the 500 and the 1,000 rupee. We need to stop it because there's too much counterfeiting going on, too much black market actions. So they actually are suggesting that 99.3% of those bills made their way back in. Very interesting. I don't know if that's a fact, but this is Bloomberg, so that's what they're claiming through the Reserve Bank of India. Almost all of the demonetized currency notes have been counted and accounted for by the RBI, the central bank said in its annual report of the year. Now that's going to be pushed up, I'm sure, because they want to claim that they're doing everything in their power and it's working and so on. So that's that. I just wanted to show you this because I think it's important to understand the financial system and how it works at a deeper level, that we have central banks that are really in control of everything that occurs. With liquidity, they can basically push the economy up further and faster, or they can dry it up and destroy it all. It's up to the central banks. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel, so I do appreciate that very much. And if you want the financial education you were not taught in schools, well, these two books have it all. You can check it out at the link in the description here. You're going to be finding out about the foundation, the asset classes, how to profit, then looking at the Global Economic Collapse book. I mean, everything that fills in the blanks, really, of the other book. tax incentives, making money, and so on. So check that out. There's also the audiobook version available at themoneygps.com.